It's easy to find many simple day trading strategies, including the Heikin-Ashi, MACD, RSI, moving average, stochastic strategy, and the simple strategy using Bollinger Bands. These strategies are simple and easy to follow. However, are these strategies right for you? Or, do they offer the best starting point for your trading? Every trader is unique, and what works for one person might not work for another. So, why not create your own simple day trading strategy? That's why on Trader DNA, I share a variety of trading strategies. The goal is to help you understand different approaches to trading. The more strategies you learn about, the better you'll understand what works best for you. Hey guys, welcome to our video on a must-have scalping and day trading template that can guarantee your trading success. This secret template is used by professional traders and top investors to achieve outstanding results. You heard that right. This top scalping and day trading template is rarely taught to beginners. So, in this video, we'll provide you with a clear step-by-step guide on how to trade effectively in Forex, stocks, commodities, and other financial markets to consistently make maximum profits. Most successful traders and investors are more attracted to simple trading strategies because they want an easy solution to reading the market puzzle. So, the important question is, why do most successful traders apply simple trading strategies? Here are the main reasons why all successful traders prefer simple trading strategies. First, clarity and ease of execution. Simplicity reduces complexity. Simple strategies are easier to understand and implement. This clarity helps traders follow their trading plans without confusion or second-guessing, which is crucial for making consistent decisions. Fewer mistakes. With fewer variables and rules to manage, the risk of making mistakes due to misunderstanding or misapplication is minimized. Simple scalping and day trading template for trend pullbacks. This is a basic guide for trading trends during the day. First, find the trend. Start by identifying the trend. Keep it simple and use just one trend following tool to assist you. Suggested trend tools. For uptrends. First, moving average sloping up or price above the moving average. Second, MACD histogram above the zero line. Third, RSI above 50. Fourth, trend lines showing higher highs and higher lows. For downtrends. First, moving average sloping down or price below the moving average. Second, MACD histogram below the zero line. Third, RSI below 50. Fourth, trend lines showing lower highs and lower lows. Second, define a retracement. Look for a retracement or pullback within the trend. Third, set your entry and exit rules. Decide when and where you will enter and exit trades based on your retracement. This template helps you trade trends effectively by keeping things straightforward. This chart shows how to use the simple moving average, or SMA, slope, to spot the market trend. When the SMA slopes upwards, it signals a bullish trend. The green background helps you see the trend direction more clearly. The next session gap down, changing the SMA direction. It's crucial to have a systematic way to identify the trend, but remember, there will be times when the market doesn't show a clear trend. Knowing when to step back and not trade is a key part of successful trading. So, the most important job for traders and investors at the start is to clearly identify the market trend without any doubt about its direction. This is a crucial step that successful traders and investors never overlook. If you want to be among the top 10% of traders, you need to master this skill of spotting the trend perfectly. Next, we'll reveal the secret to finding the perfect retracement to maximize your profits when trading signals appear. Second, define a retracement. Next, we wait for the trend to slow down and pull back before making a trade. A retracement is a temporary reversal in the price of a trend, where the price moves against the trend for a short period before returning to the original direction. Jumping onto a speeding train might get you where you need to go, but it's risky and hard to do safely. The same goes for trading trends. It's easier and safer to enter a trend when it's slowing down, rather than trying to jump in while it's moving fast. This is especially important for day traders who need to set precise stop-loss orders to protect their trades and maximize profit potential. This is where spotting a retracement becomes valuable. It helps us identify when the trend is slowing down, allowing us to enter with controlled risk. To confirm a retracement, price action alone is often enough. So, keep it simple. Let's take a closer look at a bull trend on this intraday chart. It shows various ways to identify pullbacks. When the price tests the moving average, it can indicate a pullback. In this case, the pullback was shallow and not ideal for entry. Even though you have several options, try to stick to one tool for identifying retracements. You might miss some trades, but this approach ensures consistency. If you can use the same tool from the first step, you're on your way to becoming a minimalist trading pro. Third, set up entry and exit rules. A solid trading strategy needs clear entry and exit rules. You need to know exactly when to get into a trade and when to get out, so you can act quickly when an opportunity comes up. Having these rules also helps you figure out the reward to risk ratio for each trade. To keep things simple, let's avoid adding new indicators. Instead, use the tools you've already chosen from earlier steps to decide when to enter. Here are a few entry methods you can use for long trades. First, bar patterns and candlestick patterns. Second, any bar showing a bullish trend. Third, oscillator changing direction. Fourth, a bar closing above the moving average. Once you've confirmed the trend and identified the pullback, finding the exact entry point is often easier than you think. Check out this chart for the simplest entry points for each pullback we talked about earlier. What's the easiest way to enter a trade? Place a buy stop order just above the high of the first bullish bar that appears after a pullback. First, this is the first bullish bar after a bearish pullback. Set your buy stop order above its high, and the next bar will trigger it. Second, again, use the first bullish bar after the pullback, as shown by the test of the SMA. Third, it's as simple as that. A bullish bar is your entry signal. The main advantage of this entry method is the stop loss it suggests. When you enter with a bullish bar, you can use the low of that bar as your initial stop loss level. Besides the stop loss, you also need to plan for taking profits. Trading strategy examples. First, let's see how to use the 3 parts of the trading template with a real example. One that doesn't rely on any trading indicators. First, we started by drawing a trend line to connect swing points and identify the downtrend. Second, we then waited for the price to test the trend line before looking for a trade setup. This test showed us a pullback we were interested in. Third, watching the price action, we spotted a bearish pin bar, which signaled our entry point. Since this pullback was fairly deep, the previous low of the trend gave us a solid reward to risk ratio. In this example, we used just one tool. The trend line. No extra indicators. We based our entry on a simple price pattern and set our exit at a previous support level. And that's it. Keep trading simple. Second, the 50 EMA-SUPERTREND trading strategy. Buy trade setup. First, find a strong uptrend. Look for a strong uptrend using the 50-period EMA. The trend is strong when this EMA is sloping upwards. Second, identify a pullback. Wait for the price to test a 50-period EMA, which confirms a pullback. Check the SUPERTREND indicator. When it shows a red line, it signals our retracement period. Third, enter the trade. Place a buy order as soon as the SUPERTREND indicator turns back to blue. Set your stop loss just below the SUPERTREND line. Fourth, exit the trade. Close the trade when the SUPERTREND line turns red again. Sell trade setup. 1. Find a strong downtrend. Look for a strong downtrend using the 50-period EMA. The trend is strong when this EMA is sloping downwards. Second, identify a pullback. Wait for the price to test the 50-period EMA, which confirms a pullback. Check the SUPERTREND indicator. When it shows a blue line, it signals our retracement period. Third, enter the trade. Place a sell order as soon as the SUPERTREND indicator turns back to red. Set your stop loss just above the SUPERTREND line. Fourth, exit the trade. Close the trade when the SUPERTREND line turns blue again. This should be straightforward. In this video, I've included a template with the system that you can upload to your chart. It will automatically plot all the indicators for you, so you don't need to worry about setting them up manually. Get the download link on the description. Here are other examples of the 50 EMA-SUPERTREND trading to fully understand this wonderful strategy and to make the most out of it. Instead of asking questions like, what indicators should I use? Start by focusing on what you want to achieve. Instead of getting caught up in the tools and strategies, start with understanding your goals. Once you know what you want to accomplish, picking the right tools becomes much easier. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or X to show your support. See you next time.